It has been an interesting day for financial markets, but ultimately one without progress one way or another. We start the week with the markets shaking off some of the negativity last week. Of course, that saw the worst sell off in 10 weeks for global stock markets. Things a little bit quieter this week to start until we get into the meat of things, giving us some space to get back to the nuts and bolts. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and that's exactly what we are going to do here. Get back to what macro trading, at least in my humble opinion, is going to really boil down to when you get away from big sweeping events that change markets writ large, like U.S. elections or massive responses to big pronouncements from the Fed that impact not just the U.S., not just the dollar, not just interest rates domestically, but the world over. Now we, on a week like this week, get a little bit of a window to get back to what is a trading approach that's narrower and more focused, and we find the opportunity to do something a little bit more textbook, a little bit more straightforward for a macro approach. And we get that opportunity by way of UK inflation data. And so what we're going to do here is we're going to look at what's expected, look at how it fits within the kind of big picture, bird's eye view macro narrative, look at what the price action implications might be, and then see if we can't figure out a trading setup out of this bunch. So let's begin with, first and foremost, what is on the menu. And here we have the UK CPI. It's broken down by its contributing factors, and we see that the expectations for October are that we are going to have a slight uptick from what has been a 3-year low in headline CPI. That was 1.7% in September. The expectation is that we're going to inch up here to 2.2% in October. Some of that may, of course, look like the unwinding of some of this negative influence that we've seen here. And when we consider what that negative influence seems to be made up of, we're immediately, of course, drawn to look at this sharp negative contribution, 30 percentage or 0.3% of the decline in the most recent numbers, those 1.7% numbers in the transport sector, and then 0.22 percentage points decline in what is essentially the fuels or oil category. And those obviously stand out as key headwinds, which, with some of the rebalancing in energy costs more generally, but certainly in crude oil prices, and then the knock-on from that to transport costs, that may even out a little bit in this coming data. And you get the sense that this is going to be something that's going to be motivated by a rebasing in energy, or perhaps in food, though, of course, that has been hardly a meaningful influence recently, because the core inflation number that excludes those things is not expected to have much of a change at all. Now, some aggregators have that forecast narrowly at 3.1, some have it at 3.2. That ultimately is not the world's biggest difference, in the sense that we have this sense that we are going to have some statistical and sort of time-based rebasing, but the underlying trend remains generally unchanged. And there we can see that core inflation has been kind of idling recently. Now, if we do get the down tick to 3.1, that would be relatively close enough to say that it is in line with expectations. And there, what you would expect to see would be a reading that's the slowest nominally since September 2021, so a 3-year low, but nevertheless, a far cry from the Bank of England's target, but still sort of encouraging enough that the bias would remain toward easing. And that, of course, is something that the Bank of England has already slowly started to implement. Now, where this becomes interesting is in the event that there is a surprise. And the recent data flow out of the UK has indeed suggested that the bias aims that way. The recent flow of UK economic data has increasingly diminished relative to forecast. This is data from Citigroup by way of Yardeni research. And we can see that really going back a few months now, UK economic data outcomes have cooled relative to forecasts, so much so that most recently we've actually slipped below the zero line on this index, and we can see that data now is tending not only to be cooler than anticipated, but actually is tending to disappoint overtly. So whereas up here you might have said, well, the quotient for upside surprise is narrowing. At this point, it isn't upside surprises we're looking for, it's downside surprises. And of course, what that seems to underscore is that the economy is moving with less momentum than analysts' models are anticipating. That then suggests that the upward pressure on inflation is likely weaker than the markets are anticipating by extension. And that then sets up the case, perhaps, for a downside surprise on this CPI result. As a matter of fact, we can see that the recent dynamics out of the UK economy, as captured by the most recent set of PMI numbers, this is October's figures. We're going to get November's update later this week, which we'll talk about, dedicate a whole episode of Macro Money to exploring this week. But most recently, of course, we can see the UK economy has been slowing. And this is a story that we've seen emerge out of almost every major economy, and indeed globally, with the loud exception of the United States, where conditions are, of course, quite robust. But, as we've discussed at length on the show before, that prosperity in the United States has not spilled over. It has not left U.S. borders, even though the U.S. is, of course, the world's largest economy and many of the world's leading markets, including the world's second largest economy, China, are vendors servicing U.S. demand. So one would think that if the U.S. is doing really well, that should spill over, but that isn't happening here. As a matter of fact, October at 51.8 on composite PMI amounts to the slowest pace of manufacturing and service sector growth taken together since November of 2023. So we're looking at an economy that's fizzling. And that, of course, sets up a number of interesting conclusions. Number one, it certainly suggests that the bias toward easing at the Bank of England remains, and the makeup of inflation here, just to quickly take a look back at this chart, seemingly endorses it. We can see that much of what is keeping inflation elevated at the core, not in the food area, not in what's going on in energy and energy derivative components, but what's really proving sticky: recreation, hospitality. These are areas that are ostensibly discretionary spending areas. And so if the economy were to continue to cool, as the recent flow of data surprises seems to imply, at least momentum-wise, the path of travel seems to be toward disappointment. We have a reason to think that the Bank of England might look up and say, well, why wouldn't we be easing? These are the kinds of things that are amenable to a downturn in the business cycle. And they're probably sticky because of wages that have been baked in at elevated levels into these spaces. And were there to be a meaningful adjustment there because discretionary income were to significantly leave, and the propensity to consume in these areas because of belt tightening in an economic downturn, the inflation aspect here would deflate. There is every reason, seemingly, to want to ease and to normalize rates and to try to backstop the economy under such conditions. And indeed, we do have an outlook that envisions easing, albeit not at the last meeting of the year in December. You can see here the likelihood of a cut remaining still for 2024 is very low, only 6 basis points being baked in. That's, needless to say, a far cry from the 25 basis points that are needed to actually make for a cut. Next year, we have 61 basis points on the menu, so a full 2 cuts or 50 basis points all the way in the outlook at this point, and about 11 basis points toward that third cut, which amounts to a 44% chance that we'll get that third cut, and the total comes to 75 basis points. But needless to say, the markets are narrowly seeing that as a lower than even probability. So it's a bit worse than a 50-50 shot that we get that third cut at 44%. Not much lower, not much worse than a 50 shot, but a bit worse. When we look at the way that this breaks down in terms of timing, we can see that by March, from 475 to 447, that's already under 4.5. So the 25 basis point cut has already occurred here from where we are currently over to March. And then we get sub 425 by August and almost there by June. So somewhere in here is that second cut. And then, of course, there's the slight possibility, the slight flirtation, as it were, that we could keep declining from there. So that's how the benchmark here sets up. And if you were to get a weaker than expected CPI number, as the recent flow of surprises suggests, the upshot would be that perhaps you get a slight upshift here, but you really would have to go a pretty long way. CPI would really have to surprise by a wide margin for it to make sense to say that we are maybe still going to see a cut in December, moving what would be essentially 19 basis points from here. Seems like the surprise would have to be truly epic. So that's probably not in play, but the pathway for next year could certainly get closer, and has in fact been closer even recently, to envisioning a lot more easing. And so you could get much closer to 75 for next year. Moreover, the curve here could see a bit of a twist and shift this cut here up at least into February with greater certainty. At this point, we're looking at about a 6 basis point overshoot for February, so we're not quite there, but we could see greater conviction here. And of course, this curve could angle down to a steeper setting. We wouldn't have to go far to see that kind of a thing. That's been there essentially since September, and readjusting closer to that doesn't seem far-fetched at all. The upshot from all of this seems like it would be most readily felt in the British pound. And we can see that here. So, needless to say, we've already had a very steep decline here over the course of September, October, and now into the second half of November. The British pound has suffered an epic sell-off, 7 consecutive weeks of losses, and now sits right atop the 126 figure and seems to be in digestion mode. It's tempting to want to look at this and say, well, how low can it go? And the answer is, well, it's been meaningfully lower even as recently as the middle of this year, back here at sub 125 and toward 123. So it really wouldn't be far-fetched to reach those kinds of levels. And were you to get a downside surprise on UK CPI, sort of straightforward macro narrative to follow would be, okay, weaker inflation is more scope for easing, is a weaker currency relative to the dollar, especially since we've, of course, seen already that the readjustment in recent Fed policy odds has been a catalyst for tightening the world over. Since the Fed issued its 50 basis point cut in September, and the markets reasoned that this would be inflationary because the U.S. economy isn't cool by any stretch of the imagination, we've seen a pickup in U.S. yields that has given us the sort of sense that the Fed is going to have less scope to cut rates next year. And that's been the dominant narrative since the sort of early middle of September through to now. The election and the November Fed policy announcement, as well as last week's speech from Fed Chair Jerome Powell, have only reinforced those things. We also see that those adjustments have shifted up global interest rates. This is an average of Germany as a stand-in for the Eurozone, the UK, Australia, and Japan, the top economies, top four, and these top four tradable currency economies. And you can see then the upshift in the most liquid markets following that of the US, though, of course, these central banks are pulling ostensibly in the opposite direction, and that's because of the ubiquity of the US dollar. When you increase the cost of borrowing dollars, as this upshift in yields has effectively done, what you then are doing is increasing the cost of borrowing the quintessential unit of global commercial exchange. So not only are you increasing borrowing costs in the US, you're increasing them the world over. That is, of course, a further spur for the Bank of England to want to cut, because it isn't facing a buoyant economy, as we see here. It's facing an economy that's slowing. So if that slowdown is compounded because U.S. rates are pulling UK rates higher with them, all the more reason to cut more aggressively to counteract. Moreover, the story globally has been of increasing divergence. Though the US is strong, like the UK, the global economy has been cooling since May, with only a shallow uptick in October after an 8-month low in September. And what this does to add into this mix is generate a kind of predisposition to risk aversion. No surprise, of course, that once the dust settled on the election and the focus came back to Fed Chair Powell last week and the U.S. retail sales report that confirmed his hawkish rethink with better than expected numbers, we find against that backdrop those wild selling bouts in equities that we mentioned at the top of the show that gave us the worst S&P 500 and NASDAQ losses last week in 10 weeks. So what's the impetus there? Well, it's largely this. The idea that the U.S. is pulling interest rates higher globally at a time that you have the global whole actually slowing despite U.S. outperformance, because that outperformance is staying domestic, because it is pointed at domestic service firms, and so all of that robustness is being spent at home and isn't going to buy goods, which is what the U.S. often imports. So the risk here is not only that you get dollar strength because yields are going up, but because those yields going up are stressing a global economy that can ill afford it. That can, of course, encourage liquidation and a de-risking of portfolios more generally, which, of course, is positive for the U.S. dollar as a sort of traditional destination for liquefying investments, because it is that liquid. It is the most liquid instrument. It is the most able to absorb big flows of capital being liquidated out of assets and going into cash. So not only do you then have a domestic bias in favor of the dollar from the UK side when you look at this pound versus dollar exchange rate because of a soft CPI number, perhaps, you likewise have an inherent big picture macro environment that first encourages the Bank of England's dovish impulses, and second, encourages a bias in the direction of risk aversion, which is inherently US dollar positive. For all of those things to come together, what you'd be looking for is a break of these lows right here. That's 126.20, the level back here, this reference low. We've nudged a little bit below it, and of course, got a little bit aborted along the way. That most recent low is just a hair under at essentially the 126 figure, 125.97 on the December 24 Z4 6B futures contract here, which essentially means that what you need for the next leg down to be confirmed from a tactical and technical perspective is a close basically through the 126 figure. If you get that, there's a minor low that you expose right under 125 at about 124.40, 124.50, but the really big level at that stage that you're looking at is 123, the swing bottom from June. And if you get this close, if that CPI number gives the market permission to go there, then there is, despite this long decline already on the books, ample room seemingly for another leg. And that is macro money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise on Futures Power Hour with Chris, bookending the week on Mondays and Fridays. I'm also on with Victor Jones for The Price of Truth on Wednesdays, on with Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, commenting sporadically on the platform formerly known as Twitter and on Blue Sky at Ilya Spivak. And we will be back tomorrow with yet another deep dive into macro world as we get through this week of paused U.S. event risk. Happy participating out there. Macro Money will be back. Take care.